Welcome to The Explainer. Today, we are breaking down a professional method for deciding which way you're going to trade each day. So forget the guesswork, we're diving straight into a systematic approach that can give you a real edge in the markets. All right, let's just kick things off with that one huge question every single trader faces, right? You sit down at your desk and you ask, should I be buying today or should I be selling? I mean, that one choice really sets the tone for your entire day. Instead of just reacting to every little up and down tick the market throws at you, the pros, they start with a plan. They establish what's called a daily bias. And really, you should think of this less like a crystal ball prediction and more like a strong, data-driven hypothesis that's going to guide all of your trading decisions for that day. Now, the idea here is incredibly powerful. As the source material points out, just having a bias immediately tilts the odds in your favor. Think about it. You're no longer just flipping a coin between buying and selling. You are deliberately choosing a side, which not only simplifies your decisions, but it also helps you avoid that classic mistake of overtrading. So how do you actually build this bias? I mean, it's not just a gut feeling, right? Well, it all comes down to a really simple but incredibly effective two-step framework that separates your high-level strategy from your in-the-moment execution. And here it is, the core of the entire strategy. It is a top-down approach. So step one, that happens on the higher time frame, or HTF. Think of this as your strategic big picture view, like looking at a daily chart. You're trying to establish your overall direction. Then, and only then, do you move to step two and you zoom in, way in to the lower time frame, or LTF. This is your tactical view, like a 5-minute chart, to find a precise, low-risk entry that confirms your big idea. Okay, so let's really dive into step one, analyzing that higher time frame. The goal here is to basically become a market detective. You're looking at the story told by yesterday's price action to make an educated guess about today's most likely move. So you're looking for clues in yesterday's candle. Did sellers push the market down only for the buyers to shove it all the way back up, showing that sellers are getting exhausted? Well, that might form a doji. Or maybe one day's candle just completely swallowed the one before it. That's an engulfing pattern, showing just overwhelming strength. These little patterns, they tell a story about the fight between buyers and sellers, and that story helps you form your hypothesis for today. So once you have your directional bias, let's just say for today it's bullish, you don't just immediately jump in and buy. No, now you switch down to a much lower time frame, say the 5-minute chart, and you wait. You wait patiently for a very specific, high probability entry signal to show up. Now, the source material points out two fantastic patterns to keep an eye out for. First, there's the N-shaped breakout. That's for when momentum is really strong and you want to just jump on board as it's taking off. The other one, the pullback entry. That's for when the market makes a big move and you want to get in at a better price while it takes a quick breather. All right, theory is one thing, but let's actually see how this whole thing works in the real world. We're going to walk through 4 different case studies from the source material, and we'll apply this two-step framework to a few different markets. Okay, first up, crude oil. Now, on the daily chart, we can see the market was in a downtrend. That's the red candle. But right after that, the next day, it formed a doji. This little guy is a classic sign of indecision, and it suggests that maybe, just maybe, the sellers are running out of steam. So, based on that setup on the higher time frame, a downtrend, followed by a clear sign of exhaustion, what should our directional hypothesis be for the next trading day? The bias is bullish. We're looking for a potential reversal. And the entry trigger? Well, on the lower time frame, the market pushed up and it created this tiny little price inefficiency that's known as a fair value gap. When the price pulled back into that gap, that was it. That was the precise, low-risk signal to buy, and it lined up perfectly with our bullish bias. Next up, let's take a look at Bitcoin. And here, the story is pretty much the exact opposite. We see a really strong move up, this big green candle, but it is immediately followed by a doji right at the highs. This is a huge signal that while the buyers were strong, sellers stepped in and just slammed the brakes on that advance. So with that really clear rejection up at the highs, a sign that sellers are defending their territory, which direction does that suggest we should be looking to trade the next day? The bias here was clearly bearish, and the entry trigger came from a classic N-shaped breakdown on the 5-minute chart. Price tried to move up, it failed, and then it broke down decisively. I mean, that's the perfect confirmation to enter short. Now let's look at silver, and this one is a real powerhouse. Check out the daily chart. The previous day's price action is just completely swallowed up or engulfed by this massive bullish candle. That is an incredibly strong signal that buyers have taken complete control. I mean, after a move that aggressive and that decisive, what's the most likely direction for the next trading session? The bias was, without a doubt, bullish. But what's so cool about the entry here is that the market actually dipped down at first. It tricked sellers into thinking it was going lower. But for a trader who already has a bullish bias, this trap was the perfect trigger to buy because you knew those sellers were on the wrong side of the big momentum. And finally, let's look at the USD/JPY currency pair. The key thing to see on this daily candle is that really long lower wick. It tells us a story. Sellers tried to push the price way down, but the buyers fought back, and they fought back hard, pushing it all the way back up by the end of the day. That long wick, it's a huge clue. It's like a footprint of strong buying pressure. So after seeing that powerful rejection of lower prices, what's our most probable bias for the day? Yep, the bias was bullish. And the entry trigger? On the 5-minute chart, the price just went sideways for a bit, building up energy in this tight little consolidation box. When it finally broke out to the upside, that was the confirmation of our bullish bias, and it provided a super clear momentum-based entry. So, you see, the whole point of this entire process is clarity. When you have a clear directional bias and you have a specific entry trigger you're looking for, you just trade with so much more confidence. You stop chasing every little random move, and because you actually have conviction in the day's direction, you can hold your winning trades for much, much larger gains. This whole process just brilliantly shows the power of having a simple, repeatable plan. You start with a big picture for your direction, then you zoom in to pinpoint your entry. Really, the only question left is, how are you going to apply this framework to read the market's story tomorrow?